big topic of conversation when we're answering questions around retirement planning. Life expectancy is a massive component to the retirement planning, because if life expectancy for your family or for your physical history is in the 80s, well, that's a completely different plan,
Right.
than if you have family members living into their late 90s, even 100s.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business. The advisors discuss some of our firm's investment processes. These are just a few of the many possible approaches to investing. Individual results may vary depending on your goals, risk tolerance, market conditions, and other personal factors. Please consult a qualified financial professional before implementing any investment strategy.
Welcome to the Market Moment. This is Matt. Today I'm here with Eli
As always,
and John.
happy to be here.
Good morning.
Okay. We're not going to let Eli talk anymore. So today we're going to talk about average retirement age in the U.S. We're going to talk about real estate, mortgage rates. We're going to talk about fixed income, which Eli's all jazzed up about. So we got a couple good topics, so we're going to just jump straight into it. Quick shout out to Arkansas basketball. We look really good. So
Ooh,
it
they look great.
should be a fun year. Could be a fun year. But anyways, Oklahoma State women's team won yesterday. I did see that. So, all right. So average age of retirement in the U.S. So Eli, what was the age? So you saw something on NerdWallet. We were kind of looking up just respected sites that, because you could probably find slightly different numbers on a few different sites. But NerdWallet had it at what?
Well, one of the surprising things when you look at the number is that the average retirement age is continuing to increase. So we're getting older and older, and that's a trend that you're seeing really in all facets of financial lives. People are buying homes later. Like, I think if I remember right, we did a podcast talking about the average age that someone purchases their first home, and it's now 35.
It was in the
or
30s,
38.
yeah.
It was in the late 30s. Well, the same trend is true now for the average retirement age. So the average retirement age as of 2025, according to NerdWallet, is 62 years old.
Nerd wallet.
Yeah.
I shouldn't say that.
So
Keep going.
62.
Is 62?
62.
And you said in 91 it was, so like 30-something years ago.
Yeah, I wasn't prepped for that, but it was
Sorry.
57.
57. Okay, so back in like the late 80s, early 90s, it was 56 to 58, somewhere in there, depending on the data that you look at. Now we're at 62. Okay, so then we started thinking about, okay, well, how has life expectancy changed over that same time period? So this is according to a website, Macro Trends. No idea about the validity or accuracy of the data, but there's just all kinds of things. They had then an easy chart to use. So back in 91, this data shows the average life expectancy in the U.S. was 75.3, and today it is 79.4. So, there's a 5-6 year age difference between life expectancy, and there's been about a 5% age difference in how the average age of retirement has changed.
And that's a big topic of conversation when we're answering questions around retirement planning. Life expectancy is a massive component to the retirement planning, because if life expectancy for your family or for your physical history is in the 80s, well, that's a completely different plan,
Right.
than if you have family members living into their late 90s, even 100s.
Yep.
Now.
Yeah, and when we're solving for your the potential success that you might have in retirement and the probability of success, if you're expecting and you're like, hey, there's a very good chance I live to 85 or beyond, right? And we're trying to retire early. It's like it's could be 30 years of retirement that we're trying to fund, and so
And there's more recently there's a huge trend that if you make your way onto any financial forum, you find any Facebook groups around retirement, if there's a place that you go to, you'll quickly find the term FIRE, which is financial independence, retire early. And it's people who are sacrificing drastically today, trying to get their savings rates to 30, 40, 50% so that they can retire as soon as possible. Well, with life expectancy continuing to rise, I mean, by the time that I get to life expectancy, it may be in the mid 80s. And
You're going to live to 120, Eli, and you're going to have to work till you're 84.
Yeah.
That's just the way it's going to be.
Oh, I hope not.
There's a lot that you have to take into consideration. So John was talking about earlier about, when you're retiring, if the average age is 62, there's a bunch of factors that come into play
Sure.
from a planning perspective with Medicare, Social Security. So talk through some of the things.
Well, these are just basic little numbers out here, little tidbits. If you're born before 1959, these are just little data points. Your full retirement age of Social Security is 66 years and 10 months, right? So you should know that. If you're born 1960 or later, it's only 2 months longer, but it's 67, right?
Yeah.
That's one little thing. Age 62 is the earliest age to start receiving Social Security benefits. Age 65 is when you're eligible for Medicare. And the longest you can delay taking Social Security is age 70.
Right.
All right. Well, these are all important when we're doing financial planning. I think the medical part of it is of massive importance. If you retire early, you're going to have to take care of your medical expenses.
And by early, you mean
before 65.
Pre-65
Pre-65.
Medicare eligibility.
Right,
Yeah.
right. So that's one of the biggest concerns anybody has when they come in and they want to retire at 58, 61. How are you going to bridge that gap? Because medical insurance ends up being one of the biggest expenses they have until Medicare takes over at 65. But anyway, these are just little data points of why age of retirement is important to know and when the average is. Now, one little side nugget. Go back to when Social Security was founded in the 1930s. The average life expectancy was like 2 years after Social Security started. So you think about it. Today we talk about all these Social Security questions. People wonder if it's going to be around forever and all that. Well, they installed it to only be paying out for a minimum amount of years. And
Which
as
today
life
would be
expectancy-
77 years old.
Exactly. Think about it. If they kept moving up the age with life expectancy, Social Security wouldn't start till your mid-70s. It's crazy to think about that. But
Another statistic or another kind of nugget of information that's helpful when you're talking about retirement stages and parts of retirement that change as years come is that what I call like a financial birthday of 59 and a half years old. So not having access to most of your
Right.
retirement assets until you're 59 and a half can be a pretty big restriction for a lot of people to retire pre-62 because you're quickly coming against a data point where you can't distribute without a 10% penalty with some variance there.
Right.
You can, but it's fairly complicated
and
in most ways.
we talk about planning all the time on the show. Right? We have all these. We kind of regurgitate the same information for every time we have a different topic. But you want to retire at 55, you need to have buckets of money. Some that are qualified Roth, whatever, which is your normal retirement stuff. But you also have to have some non-qualified assets that you've saved up to help bridge the gap between then and when you can start taking without a penalty at 59 and a half. You also have to worry about your health insurance, which we just talked about. Social Security doesn't start till later. In most of our planning, when we do planning, at least in my experience, the optimal age of starting Social Security is always pushed out later and later because we are expecting our clients to live to 95. And we don't know that. God only knows when they're going to pass away. So if you live to 95, you should hold off on taking Social Security as long as you can, because it's better for you if there's a break-even point. But all those factors go into play. If you're going to retire at 55 and you're going to wait for the optimal time to take Social Security, you're going to need 15 years of income coming from sources that aren't your Social Security, if that makes sense. And if you do live to 95, that would have been the smartest thing to do, to wait as long as you could.
Yeah.
So there's so many factors.
And that's a part of, I was surprised to see that the number was 62 years old. I would have anticipated it closer to 65, just solely for the purpose of that's really where most of the government benefits start to kick in and make it much easier for someone to retire at 65. Most of the complicated parts of retirement planning happen pre-65.
I was going to ask you if you were surprised at the 62. Is that, would you have guessed? What would you have guessed? I mean, it's hard now because
Well, I would have guessed maybe around that. I mean, I'm not sure, but every time I have young people come in the office, their dream ages are going lower.
Oh,
Yes.
sure.
Yeah, so like
50s is like the expectation.
Yeah, my generation of workers, and I'm 54, it's kind of the expectation you work till you're 65.
Yeah.
Right. And older generations, like my parents, not your grandparents, my parents, they would work until they couldn't work anymore.
Yeah.
I mean, it's kind of like those, work till you're 65 or 67 was just a no brainer. So I am little bit surprised it's 62, but I'm not surprised that it's potentially. You said it's going up in difference of age, right? From previous years.
It's increased.
That's surprising to me because of all the young people. Of course, my age is starting to retire.
Yeah.
So I get that. But
62 would have been the earliest I would have guessed. I would have probably guessed closer to 65 just for average.
If you talk to young people that are doing well in this, they're like Eli was saying, you're pushing a bunch of money to savings. The idea of retirement is much more. I don't know if it's just because of social media and all the things we have to
access
look
to
at.
information.
Access to information. People just want to save more and get. It's just a smarter generation of that.
When you look at any statistic around Gen Z, so that would be 1996 and younger, their savings rate relative to previous generations is significantly higher.
Right.
So Gen Z is the kind of that generation that's had all the information at their fingertips, and they know I should contribute, I should save. Because they've seen and they've been instructed by previous generations now of what they should be doing.
Yeah.
Exactly right.
Okay, so we're going to move on from average age of retirement to real estate and mortgage rates. So this is a really big deal. The real estate market's been in a recession, on ice, frozen, not moving, whatever you want to say.
Yeah, it's been a slow pocket of the economy.
Yeah, for a while now. And so we've started to see a pickup in activity, whether it be refinancing or homes starting to sell that have been setting for a while. So I don't know where we're at today. I haven't seen it this morning. But the 30-year mortgage rate has been trending down. I've got this is a few days old, but this is from the Federal Reserve Bank of St. Louis. Their 30-year fixed rate mortgage average across the U.S. As of like 4 or 5 days ago was 6.17, right? You go back to May of last year, so May of 24, we were in the sevens. This late 23, we were 7.7. I mean, high sevens. So now we're getting down to around the 6. I'm sure there's people out there that are able to get sub 6 now, right?
If you have high credit score, the average doesn't apply to you.
Right.
Because if the average is 6.1, you're probably looking at 5.6, 5.7.
Right.
If you're in the 800s.
So 5.6 compared to 7, I mean, that's a huge deal, especially with home prices or home values still elevated. Home values haven't come down dramatically. So, if you're trying to buy a $400,000 or $500,000 house, a 1% difference on your mortgage makes a very material difference on your monthly payment.
We're also getting to the point now where mortgage rates are so low relative to what they have been the last couple of years that you can begin to introduce the topic of refinancing for people who have bought in the last couple of years.
Yeah, I've had clients that had rates in the 7%, which is kind of like finding somebody in the 2%, right? It's a little bit, that's the two spectrums. So if you got a 7, you're now able to.
Yeah, if you look at the last 15 years, those are the extremes.
Those are the two extremes,
2s
right?
on the low end, 7s on the high end.
And if you have something in the 7s, you might be able to refinance it right now. It's kind of like a old way of thinking about it. If you had a % or more decrease in rates, it might be worth refinancing with all the costs that come with refinancing. You don't want to refinance if it's down a quarter point or half a percent. But we're getting to the point where some of the higher rates are getting that point or higher difference where there could be refinancing, which has been a dead market in banks, which that used to be the bank's biggest revenue stream was refinance when the rates were going down and everybody was refinancing. And then that ended, that part of the banking cycle ended, and now that's starting to be reintroduced. I had a client that came in the other day and had a 7-point-something%, and she is getting called all the time by her banker to refinance.
Sure.
Right. They're getting back into that game, which they haven't been for a long time.
And I had a client, they were in the 7s, I believe, or high 6s, and they were able to refinance, shorten the note, and they were able to refinance, shorten their note, and pay less monthly, and they didn't have to pay anything for the closing costs. They just wrapped it into the mortgage, and it was like, that's a hard argument to say you shouldn't.
What's your advice on because everybody ties, the Fed decreasing rates to, mortgage rates are going to come down. As we know, those
it's not really true. Yeah.
Those two aren't, it's not, one does not equal the other necessarily. Mortgage rates are more closely tied to the 10-year treasury, right? Which has been coming down. The government shutdown kind of led to a little bit of a drop in the 10-year treasury, just some of the uncertainty and But if we're staring at the Fed and thinking, hey, and I'm not saying this will happen, but if you think, hey, the Fed's going to cut in December, or we're going to be on this
Cycle.
3 to 6 month trend that the Fed cuts a couple more times, like, do you refinance now or do you wait, or like what kind of advice or thoughts do you have on trying to time that to get, because it can be costly to refinance, right? You don't want to do it and then try to do it again in 6 months, like, because then you're delaying any potential benefit. But what are your thoughts on that? Like, do you do it while you can?
I think you, again, going back to the old thing, you at least have to have 1% or more. Okay, so it's just comfort level of when you get to that point, because you're never, I don't say never, but we don't know where rates are going to go, right? We know that the threes and that little time in the twos and the threes are probably never coming back, I would guess, or at least a long time from now.
If they do, things have gotten
really bad. Economic stuff has gotten really bad, and I'm not sure we're going to get to the fours in this, but we do know the Fed is going to, it seems like, with the new Fed chairman probably coming in May and all that stuff, that the rates coming down from the Fed is going to continue, which will pressure other areas. And if you have economic conditions that are weakening labor markets and so on, that leads to the 10-year Treasury going down, right? So I could see us getting into the fives, maybe lower. I mean, we dipped into fives, like Eli said. You can get 5.8, something like that. Maybe getting down to lower fives, but it's like a fool's. If you're at 7.5 and you get 5.8, I mean, that's probably worth it, right?
Yeah.
That's probably a pretty tremendous difference on your payment.
This could age really poorly, but I don't expect to see 4% mortgage rates. Really,
sure, I don't really either. Maybe ever.
While, barring something catastrophic, or barring something that's just
out of
completely
the blue.
unforeseen.
Yeah.
So if you're in the 5%, and you're saving significantly on a monthly payment, I think you just go ahead and pull the
it's
trigger.
a lot like when we tell people, it's like, don't try to time the market, right?
Yeah.
It's like you're not
make the best decision that you can at the time that's available.
Yeah.
Right.
If you can get in the fives, and you're in the sevens, it's probably worth it. I mean, in my opinion, it would be worth it.
And you just have to accept the fact, I'm going to look back and be like super happy I did it now, or be like, man, I could have got a little lower. And either way, you just.
All I know is the clients that we work with that have a 2.25% mortgage are happy, and the clients that we work with that have a 3.25% mortgage are happy. Right?
It's easy to say that when the mortgage rates are 6
but it's
right
a
now.
1% difference. The same would be true if someone had a 5 or a 6, and now rates are 7 or 8.
Yeah.
Now, historically speaking, you guys have been in the housing market,
Oh yeah,
not as long as I have.
many years.
But if you go, historically speaking, right now at 5.8, that's historically low.
Yeah.
I mean, we don't think that because recent history doesn't seem that way, but it's not a bad rate to lock in. If you're a 30-year more, 30 years is a long time, right? You're young, you lock in a 5.8, a 5.7, whatever, you're doing fine.
My quick Google told me the last 50 years, the average mortgage rate was like 7.5%.
Yeah. So we're at the lower, still below average, which is good historically, which is good.
Yeah, if you look at this 30-year chart, on the Federal Reserve website.
Fred St. Louis?
Yeah, Fred St. Louis. So if you look at where we're at now, it's like, it looks normal.
Yeah. It looks fine.
Like you look at this and you're like, oh, we're still, like, these are still pretty good rates.
Yeah. We were spoiled for 3 or 4 years there, and now we're back to normal. But rates coming down to the last wrap that up, as I do think if you're 1% or more and you can get in the fives, it might not be a bad time to do something about it.
And then so let's transition to that, because we're talking about rates, 10-year Treasury, fixed income. So Eli's all jacked up about fixed income.
Come on.
Fixed income's had a good year, right? 22 was a tough year. Early it's struggled for a while now, right? Rates were so low.
Just had nowhere to go.
It had nowhere to go, really, but down as rates rose. We finally got a little bit of rates, where you're like getting paid to be a fixed income investor. Rates have trended down, so that's led to what this year for fixed income?
The fixed income, to get excited about it, you have to know the story and the background as to why I'm sitting here and I'm excited about what's going on in fixed income. If you go back to 2022, so 2021 into 2022, rates were relatively low, or really low, you could only be paid a little bit to hold on to a bond. So 2022 came, rates rose, and fixed income got hammered. Fixed income for 2022 was down like 13%. So if you held a bond or a bond fund, you just saw your portfolio decline by 13%.
I'm going to stop you real quick. Let me explain it real quick. If you own a bond at 2%, 3%, 4%, and interest rates go up to 6%, and you're holding a 4% bond, that value of that bond goes down. And that's what we're talking about.
If you were to sell it in that year.
Yeah, if you're to sell it in that year, you could keep it for the term and get the 4%. But if you want to go get the 6 and you want to sell it to get the 6, you're going to sell it at a discount. And that's what we saw in funds. And yeah, sorry to interrupt you. I just want to make sure.
So you move into 2023, then rates were so high on the short end of the curve. So the way that you
we're
think about it is,
in the inverted yield curve.
Yeah. So you were thinking CDs were the answer, right? Because CDs were 5.25. You saw like 5.3, 5.4. There were some really aggressive CD rates. Well, then you don't want to invest in bonds, because why would I go take a 10-year bond that's paying me 4 and get paid less to go get a 5.25% CD? So 2023 was a hard year for bonds just to pitch it. And then if you showed anyone a historical chart of bonds, it looked horrible because 2022 was so bad. So 22 was bad, 23 was bad, 24 was kind of more of a normal year in bonds, but still CDs were high, treasuries were high. It was hard to convince people to invest into them. Well, now we're starting to see the fruits of taking some of your lower risk portion of your portfolio and investing in bonds. And we're seeing the diversification that bonds can provide this year with what would be considered like a benchmark for bonds, the AGG, up 6.7% total return for the year.
That's just kind of like the total U.S. bond market.
Yeah.
Right.
Total U.S. bond aggregate. Yeah.
So if you're looking at that and you say, okay, 6.7%, if you were to go do something else on the short end of the curve, now you're paid 3.7%. So we've effectively doubled what we could have had in CD returns this year in bond returns. But it's been a hard story to get there.
Yeah.
And to have someone who has taken money out of CDs previous to this year to go into bonds, they've seen benefits of that. But that was a hard sell.
Yeah, and everybody kind of, you knew it was coming, the transition from short term and extending duration to like, when should you do that? We've kind of done it over a period of time in portfolios where it's like you're not going all in, but we used to have more exposure to some really short term.
Yeah, when it was paying 5.3%.
Treasury positions and different things, and we've kind of transitioned out of that to more, extending duration a little bit. Our story has evolved over time, right? We used to not use fixed income really like at all, because it was like, hey, we're going to get paid essentially nothing. And if rates move at all, unless they go negative, they're going to have to go up at some point, then we're going to lose money. They're not going to provide the diversification that we need. And we've transitioned out of that over the last several years, where we've used more and more fixed income. So in a lot of ways, like as much as like a new home buyer would love to see 2% rates again, as investors, we don't want to see that. We like a healthy fixed income market where rates are somewhat normalized, where we feel like fixed income can provide, some of the diversification benefits that we need. Doesn't mean that rates can't go higher, right? We're going to have a period where something happens and rates go higher, and like fixed income isn't always going to do exactly what we need it to do. But now there's not only one way for it to move, which is when you have rates at the floor. That's kind of how it feels. Is like, well, there's only one direction this is going to move, so it doesn't make sense to invest in this right now.
Exactly.
Well, it's really nice to have the story of your portfolio that has an allocation to fixed income. The fixed income has been a good contributor to the total return.
It's actually helped.
Yes, it has. Yeah. It has helped significantly.
Yeah, I mean, we have some of our models that are more conservative models, not 100% equities, that have had really good years relative to the equity market because the fixed income has had such a good year, right? And that's true for if you've had any well-managed, good fixed income position. So it's been fun, and it's just crazy to look back, 22, 23, 24, 20, now 25, of how
we started
things can change.
Nibbling back into bonds in 2023, and they had a positive, fairly decent year in 2023. Not great. 2024 was a kind of a lost year, but didn't hurt you.
Yeah.
In 2025, they're back up to those beginning to normalize rates. which is good, which leads back to the old efficient frontier, the old models that we used to use, well, before you guys were born, But they were out of place, right? Because bonds didn't participate.
Right.
So that 60-40 model or whatever did not work from 2009 through, a year ago.
Yeah.
And now that's starting to come back into play where you can actually do the model where you have the fixed income and you have the equities and you build it together like it used to be. It went away and now it's kind of back, which is nice.
Yeah. Yeah. Any final thoughts or words on topics of today?
Just excited about that.
Yeah.
I'm sure everybody listening is very excited about bonds, interest rates.
If you're as excited as I am, comment below.
Yeah.
Somebody is.
It makes our lives so much easier when asset classes are doing what they're supposed to do. Per the textbooks, because it makes it easier to build portfolios and get clients what they need. So
exactly.
I enjoy it.
Yeah.
I don't know if I like it as much as you, but
clients love it.
Yeah. Well, good conversation today. So I think the one takeaway for me would be, we're talking about average retirement age. Just know, it's interesting data. There's things that you need to be aware of. But I think my takeaway is it doesn't matter. Who cares what the average is? Right?
Exactly.
Know what you want to do, set a plan, put things in place to accomplish that. That's just the data of what the average is, what the average life expectancy is. But we have clients sometimes that, ask us questions of how do I compare to, other, and
I
it's
get that a lot.
It doesn't matter.
No.
If we can define what you want to accomplish and help you accomplish that, that's what matters. And so if you want to retire at 50, 55, let's set some goals and go make it happen.
Exactly. Amen.
All right. Well, appreciate you guys. Fun conversation. As always, we appreciate you guys watching and listening. And give us a like, subscribe, comment, share it with your friends on social media. Shoot us an email if you have any questions. We'll look forward to seeing you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.